Good morning, everyone. Hi, I'm Raymond Opara, and welcome to this edition of our Investment Playbook webinar. We are extremely pleased to host our extreme participants for this webinar, being the first of the year, and we promise an insightful presentation. 2022 was a year financially teamed with policy normalization. Per our last webinar for Q1 2022, we highlighted expectations that linked majorly to global market recoveries from the long-lasting COVID-19 pandemic. But very unfortunately, on the 24th of February, global markets witnessed a shock as Russia invaded Ukraine. This devastating act is the bedrock of today's webinar, being geopolitics, great inflation, and market volatility. The major purpose of this webinar is to give our esteemed participants vital strategies to optimize their portfolios, given this current market conditions. And so myself, on this webinar, we have Robert Omotunde, the Chief Investment Officer. We also have Temitope Omosuyi, our investment strategist. We also have Babajide Atolagbe, who is our investment risk analyst, and we have our fund analyst, Victoria Injimanze. So basically, on this call, for the last webinar, the Q&A box open for all questions, and we hope to answer them at the end of the presentation. So right now, I implore you to sit tightly and take in this wonderful presentation as I hand over to Robert. Robert, over to you.
Thank you. Thank you very much, Raymond. And thank you to our listeners, our audience for joining this webinar, the first in the series for the year 2022. And just as the title suggests, we're looking at geopolitics, great inflation, and market volatility. And then we'll, of course, be looking at the strategy for you to optimize your portfolio amid these challenges that the global economy faces in the year 2022. So with me to anchor the presentation, three of my colleagues. Victoria will be taking us through the global and domestic macroeconomic review. Babajide will take us through global and domestic financial markets. And Matthew will be anchoring the main topic of discussion, which is geopolitics, great inflation, and of course, market volatility. Then I'll come back to take us through the strategy for portfolio optimization. So now I'm going to just hand over to Victoria to take the floor. Thank you.
All right. Thank you, Robert. I'll be taking us through the global and domestic macroeconomic review for the first quarter of the year, as well as our outlook. Now, since the Omicron variant of COVID-19 was named by WHO in November 2021, it has moved at lightning speed. In less than 3 months, it has spread around the world. It has caused record peak in cases in many places, and it is now declining just as quickly. In most places, the worst of the Omicron variant has now passed, leading to some loosening in public health measures to a degree that has not been seen in almost 2 years. Now, China, however, continued to grapple with rising cases as it recorded its first deaths earlier this week with deaths of 3 elderlies. And China's latest wave of the COVID restriction has forced millions of people to stay home and undergo some mass virus testing in Shanghai. But overall, that just accounts for less than 2% of reported cases, which is a good one for global economy. Now, as countries continue to nations continue to unwind the unprecedented level of fiscal and monetary support, we expect global growth to slow down this year. Recovery in growth has now been hit by a potentially huge global supply shock that will now reduce growth and push inflation. And more recently, we have seen international financial institutions revising their forecasts lower. Let's take World Bank, for instance. Earlier this week, we saw World Bank revise lower their 2022 forecast to 3.2% from 4.1%. The war in Ukraine, economic sanction on Russia, they have all put global energy supplies at risk. And the ongoing supply chain bottleneck, rising inflation, and other things just continue to put most countries at higher risk for slowdown in economic growth. Now, United Nations Trade and Development Body has also seen worsening prospects for global growth in 2022, and they have also revised downward their forecast of 3.5% to 2.6% on the back of the ongoing crisis, which would induce pressure on global supply chain, higher inflation pressures, among others. Now, inflation has always been in our faces since last year and even to this year. Inflation continued its upward trend across countries in the world. Our chart there just projects a 12-month trend in Eurozone, in China, and in the US. And latest inflation numbers from the US shows that inflation came at 8.5% for the month of March. For key drivers, continue to see soaring energy price take the lead, as energy index in the US rose 11% in March, and gasoline index went up to 18.3. That was something that printed at around 6.6% for the month of February. And overall, for the last 12 months, we have seen energy index go up by almost 32%. Then supply chain issues making everyday goods harder to find, and the ongoing crisis just for that exposes global supply chains to more vulnerability. Now, on the back of rising inflation, we have seen a number of monetary authorities raise rates to get it under control. Our chart here just shows notable monetary responses to it. We are seeing Fed shift gear to inflationary fighting mode. Brazil has raised rate 4 times already this year. The country has waged one of the most aggressive interest rate tightening cycles in the world as they continue to struggle with spiraling prices driven up by the fallout of the pandemic and now the geopolitical crisis, and with the expectation that even at their next meeting, they're going to hike rates by 100 bips to take it close to their 3.5% target. And most notably here in sub-Saharan Africa, Bank of Ghana has also raised their rate by 125 bips to just reflect the new geopolitical events that has further heightened uncertainty. Now we want to look at how emerging market has fared in terms of capital flows, and we are seeing that there has been a significant deceleration of flows into emerging markets as most of these countries continue to grapple with higher risks following policy normalization in advanced countries, as emerging market assets would now have to be repriced, the ongoing crisis, and rising debt stock. Now, at the end of all of this, we just want to give our outlook of where we think the economy is going to go in 2022. For us, on the COVID-19 front, the prospect for the rest of the year and even beyond is hinged on the question of whether and when future variants would emerge. Whether and when future variants will emerge, as long as Omicron remains the dominant variant, there's reason for relative optimism, and we expect to see the current trend sustained as both vaccines and boosters are proving quite effective and rapidly scaling, bending the curves in many geographies. For global growth, we still expect economies to face challenges and to face some downward risk following the effect of the war and the strain that has been placed on supply chain and vulnerability. Then global trade also expect the ongoing geopolitical crisis to continue to see mounting trade costs across the world and lower trade volumes. And we do anticipate that this will slightly improve in H2. Also for rate hike, we've seen clear directions that we expect much more rate hikes, as the year goes by. And even then, inflation will still be subject to development in the world, supply chain disruptions, and energy prices that are outside the purview of the monetary authority. And for the flows into emerging markets, concerns are still around the volatile capital flows, exchange rate instability, the rising cost of borrowing, amongst others. Now, when we look at Nigeria, looking at the growth on the growth front, last year we did see some improvements in growth to 3.4% thanks to the non-oil sector performance. However, we do want to highlight that this is a rebound off a low base. So what we are anticipating this year is that we do see some of that rebound begin to fade, which is why we are projecting 2.7% for full year 2022. And we also highlighted the oil and gas sector performance. We saw production fall in 2021, which was less than the production level that we saw in 2022, which undermined the higher energy prices that we saw in 2022. Then looking at the subsector performance, service and agriculture sectors were the brightest spot. 2021 figures just show that our external sector still remains under pressure. Looking at some of the performance of some of the components of the balance of payment, deficit on good accounts can be linked to the underperformance in crude production, as we believe that, and also the income account, which we can also link to the sharp drop in or decline in capital importation. And looking at capital importation chart, you see that it has declined, it has been declining since 2019 and declined 51% year on year to close full year 2021 at $6.7 billion. Now, in regards to exchange rate reserves and inflation, now despite seeing oil prices still increasing, reserves did not really pick up in that same manner. Outside the SDR and the Eurobond issuance that we saw last year, we did not see much of an improvement in that sense. So in typical environment like this, we see government source for alternative source of FX liquidity, including external borrowings, which speaks to why we did see Eurobond issuance earlier this year in March of around $1.25 billion, which is supposed to show up reserve position. Now, speculation on Naira has also further risen with CBN banning the sales of FX to BDCs, while our inflation rate still continue to maintain this upward trend that we have seen, no thanks to both imported inflation and higher energy costs. Now, looking at our budget, Nigeria still continues to expend more than she makes, taking our deficit even higher. And even now with the revised budget that has been passed and approved last week, we now have a total budget side of 17.3 trillion, that represents an increase of around 193 billion, with subsidy payments now estimated at around 4 trillion. We did highlight some events that we think would impact the 2022 budget performance, among which we have inflationary pressure, oil theft and vandalism, and the increasing deficits that we have to make. Now, for domestic outlook, we did highlight some things that we think are worthy to note. First off, the revenue. We expect revenue on the performance to continue to linger. Revenue outlook is still subject to a lot of uncertainty, especially around oil. We expect inflation rates to still continue to keep upward. For external position, there are upsides for our current accounts, because we continue to see higher energy prices, but this will be undermined by the underperforming crude production that we currently have to deal with. Also, the low crude production that continues to hurt the revenue expectation. I'll be handing over to Babajide, who will take us through the global and domestic market performance for the first quarter of 2022.
Thank you, Victoria. We all know that 2020 is actually off to a rocky start for the global financial markets. I mean, in Q1 alone, like Victoria rightly mentioned, we've seen high inflation across major economies, Swiss policy normalization, and heightened geopolitical tension. And this has clearly dampened investor sentiment and increased volatility towards the downside. And I remember that on our last strategy call, we had anticipated that many of these fundamental factors will actually affect the market, but we definitely didn't see the Russia-Ukraine crisis coming. Income space, government bond yield actually rose, in Q1, as central banks came in more hawkish, forcing market to actually price in a faster pace of policy normalization across developed markets. However, the degree of rise in yield varied across major markets. For example, the US Treasury rose from 1.5% to 2.3%, while UK actually rose by 0.7% to 1.6%, speaking of the 10-year yield. We also saw a similar fashion in France, Germany, and Japan. And amongst the BRICS region as well, we saw a similar trend, save for China, whose government was much more dovish in Q1 in a bid to support the slowing economy. For sub-Saharan Africa as well, that particular market was not left out, as the increase in yield in developed markets actually forced the repricing in that space as well. Going forward, we expect the broad-based policy normalization and, of course, heightened geopolitical risk to actually dampen fixed income sentiment in Q2. For equities, the sharp increase in treasury yields across the world has placed a dent on the performance of global equities, as we all know. And fundamentally, higher interest rates affect dividends, profitability of companies, and also it affects valuation of equities. Additionally, shrinking disposable income as a result of the ongoing inflationary pressures and also tighter labor markets are also factors that have affected global equities in Q1. Not to also put out the geopolitical tension that's actually weakened investor confidence and forced capital flight out of emerging and frontier markets. We can see that across all the indices that we track, many of them are actually in the red. And the biggest loser, of course, is Russia, which is down by 35% on a quarterly basis. And we all know the story behind that, given the tension we saw in Russia and the sanctions that followed, while Turkey performed the most, up by 23%, simply because the Turkish government has been largely dovish since Q4 2021. We expect this trend to be sustained as well in Q2, as higher interest rate continues to dampen investors' pricing for equities. For currency, it has been a great quarter for the US dollar, as increase in interest rate discussion has helped the dollar to gain more value fundamentally. For European countries, the performance has been largely mixed. Most of the gains that these countries have accrued since the beginning of 2020 has been offset by the geopolitical tension in Europe. For BRICS region, you can see that the BRICS region, they actually outperformed when compared to the developed markets, simply because the commodities market, we saw a rally in the commodities market, and that actually helped these countries shore up their reserves due to their current account, the increment we saw in their current account during the period. But Russia was the black sheep of that space. The currency was actually down on the quarter by 12%, given the impact of the war. For frontier markets, that market also suffered from rising inflation, high debt levels, and significant capital flows in the first quarter of the year. And Ghana and Egypt are good examples of countries that have actually suffered from that development. Moving quickly to commodities, commodities has been the winner of the war so far, right? As prices have actually trended higher, given the supply shocks. And of course, energy is remain the best performing component across the equities, across the commodities space, given the fact that the imbalance we have in global demand and supply. The agriculture also trended higher, with commodities like wheat, palm oil, and corn all recorded sharp gains during the quarter, given supply deficits that we saw. While for precious metal, it was actually very attractive in Q1, as investors actually demanded for safety assets. For the commodities market, we think that the market will trade in similar band in Q2, given that there is no further escalation in Eastern Europe and sanction levels remain the same. For cryptocurrency, for the first time in a long while, we saw that the market actually reacted to global headline risk, right? And if there's anything we've learned from this event is that digital currencies, particularly Bitcoin, is not necessarily a hedge against macro or headline risk, as suggested by many crypto enthusiasts. We noticed that the performance of Bitcoin tracked the performance of risk-weighted assets and tracked the performance of indices like NASDAQ and S&P during the period. Bitcoin opened around 46,000 in the year, fell to as low as 32,000 during the peak of the pandemic, and closed at around 45,000 levels. Going forward, we expect to see further volatility in that space, as the normalization of policy rates will tighten liquidity, and of course, the development in Russia will also affect the pricing of that particular market. Real estate, we know that in Q4 2021, the fact that we had low mortgage rates, improvement in wage growth, and of course, the high government stimulus, all of these factors supported the real estate sector in 2021. But if you notice in 2021, in this area of tighter financial condition and geopolitical tension, you can see that the Vanguard real estate index and the iShares real estate index basically reflect investors' expectation of the real estate sector in 2022. You can see that material decline that we've seen in that particular space. So we expect the supply shocks and all the challenges that come with mobilization of real estate materials across Europe to actually affect the pricing of the industry, and also the fact that the cost of fund is actually going to get higher to affect demand for real estate assets. Moving quickly to Nigeria, we note that in Q1 for the fixed income space, market actually traded positively, as yield actually declined, particularly on the short end of the curve. Unlike what we had in the BRICS region and in developed markets, where yields were rising, in Nigeria's case, yields actually declined. And this is because the market was largely dominated by demand and supply factors. On our liquidity table, we can see that for the most part of Q1, the market was, we had free liquidity in Q1, which was also responsible for why we saw a decline in yield. But going forward, we expect that the market is going to be tight in terms of liquidity. As you can see, the time we have a beta is in September. So the liquidity dynamics is actually against interest in the fixed income space. Thus, we have believed that yield will actually trend higher. Aside from the liquidity dynamics, we also believe the fact that the elevated budget deficit by the government will spur more borrowings from the government, and of course this will the government will have to incentivize investors by actually increasing rates, and of course the MPR rate is likely to rise before the year runs out from 11.5% to 12% in a bid to actually show the world that we are actually ready to keep capital in Nigeria. To domestic equity space, the market actually gained in Q1 as well, up by 4.7%. And largely speaking, the performance of that of the index was largely driven by the development in the oil and gas space, right? Oil and gas saw significant traction, even the rally in the market, and that was majorly responsible for why the market was up. In terms of gainers, we have Wema Bank, which was up by 294%. This was spurred by some discussions around mergers and acquisition. Guinness and PZ also topping on that chart. On the flip side, we have Carviton, UPDC, and M Benefits. Going forward in Q2, we expect the market to also trade a similar band. Also, we note that there are some macroeconomic challenges that could affect the pricing of equities in Q2 and Q3. And lastly, the fact that yields in the fixed income space are rising, this could spur some sort of valuation problem for the risk-weighted asset like Nigerian equity that could actually affect the pricing, and also we see some sort of capital movement away from risk-weighted assets to safer investment like fixed income. Thank you. That'll be the end of market review and outlook from me. This time I'll call Tim Chokwe to continue from here.
All right, thank you, Babajide. Yes, so I'll be taking us through the three important events that underpins our investment strategy outlook for the rest of the year. So I'll be looking at geopolitics, great inflation, and market volatility. I'd like to start with geopolitics. And we all know that there are several geopolitical tensions in the world, but on the front burner right now is the rift between Russia and Ukraine. And we need to provide some historical context. Ukraine was actually one of the 15 European states that left the Soviet Union, and the country actually got independent in 1991. So over the last 30 years, the country has been struggling in terms of political situation. And this is actually because immediately the country got independent, they started tilting towards the West, and that was like they were stepping on the NAS of the Russian government, so which led to significant, streaks, and a lot of volatility on the curve of this country democratic system. And for Russia, same got independent, and in the last 30 years, Vladimir Putin alone has been in power for over 17 years. So now moving on to the timeline for the political events in Russia and in Ukraine, to be precise. After the independence in 1991, the country was able to sign a pact with Russia to denuclearize, which happened, and after some years, about 10 years, the country went into an election after a series of tussle in terms of the political situation, and which led to what they call the Orange Revolution. What happened in this period was that the Russia bank aspirant was claimed to have won the election, while the aspirant was said to have lost the election. So that led to a protest. But at the end of the day, the people were able to have their candidates as the president in the person of Yushchenko. This Yushchenko actually was in the country led for about 3 to 4 years, but because it was NATO, which is really against what Russia wanted, that led to a lot of upheaval in the country. But Zelensky actually promised when he came into power in 2019 that it was going to reduce the upheaval in the country by not going into war or having a kind of rift with Russia, and also eliminate corruption, because that was the bane with Yanukovych, which was a Russian-backed president
that was in power in 2014. So moving on to what happened afterward, particularly in January 2021, Zelensky that promised the citizens to have not go into war and to also not incite anything that will put Russia even into the country in terms of military invasion. He changed in 2021 by tilting towards NATO again, which was like he had also followed the path of Yeltsin, and this actually led to what we saw in September 2021 when Putin angrily responded by putting Russian troops near the Ukrainian borders, and this actually gets a lot of security dilemma. And Russia actually stated clearly, because of the strategic position of this country, that they don't want Ukraine to join NATO or to have anything to do with European Union, because it's going to expose the country to so much of risk. And we also saw that in the same period, Russia also recognized Donbass, which was more like a secessionist region in Ukraine, as a sovereign entity. In February 25th, that was the last straw that actually broke the camel's back. Russia actually invaded Ukraine because they felt that most of their conditions were totally ignored. So, and in February, we saw a lot of sanctions that affected financial system, manufacturing sector, and of the Russian economy. So, moving on to what Russia really has in this whole game. It's very important to know that Russia, is the largest supplier of energy to European countries, and most of this pipeline actually pass through Ukraine to a number of European economies. So once they are able to bring Ukraine to their side, I mean Russia, they will have significant presence in Europe, and that will also help the country to consolidate its power, that is Russia. So another point here is the Westernization of Eastern Europe. Russia is largely autocratic, and any country within the Eastern Europe that is moving towards the Western world, they are moving towards democratic system, and the leadership take its toll on the current leadership architecture in Russia, and that will affect Vladimir Putin. So it's also very important that in terms of trade condition as well, Vladimir Putin is also looking at how, if Ukraine is on its side, and how that will foster what we call the Eurasian Economic Union in terms of trade integration. So all of this, a lot for Russia. Brief. It's not just about the political aspect. So moving on to how this impacts global balance of power. We all know that before now, the US has been the global policeman, but China, Russia, and a number of other countries also want to be known in the global scene. So, which is why China did not really respond to the sanctions that were put in place by the US and a number of European countries. In fact, Russia now, I'm sure a number of us are now conscious of what is happening in Russia, because the country has now placed itself as a strategic economy in the world, even in terms of even security. They are now a major security threat to the world. As a matter of fact, if you look at Russian expenditure in defense to GDP is over 4% compared to even Europe. The best in Europe is about 2%. So which means Russia is actually prepared to also take the world economy from or world security architecture from a unipolar system to a bipolar or multipolar system. And you also look at Europe, also forward, begin to look at how to improve on their security, because they spend very little, way less than what Russia and China, even the US, are spending on security. And the last point here is that NATO will begin to now rethink their expansion structure, because it's actually affecting, for instance, because they want to expand into Ukraine, it's now creating a kind of ripple effect on other economies, because the current brief between these countries not just affecting only Russia and Ukraine, it's also taking a toll on a number of other countries. So for geopolitics outlook, we know that beyond Russia and Ukraine, there are lots of geopolitical tensions that are in the offing. Some have subsided a little, and some are just brewing. For instance, Russia, US, and China, the trade war that started in 2018, we know that is still even in the bag. Why for US and Iran, that started in 2001 as a result of the 9/11 crisis, is still also on the table. So, and in addition to that, US and North Korea confrontation when it comes to nuclear weapon display, that is also a major concern. All of this, we know that yes, they will continue to affect the global economy. And moving on that, we still have a number of them. We have China and Taiwan, and this is actually similar to what is currently happening between Russia and Ukraine, because this is largely on the sovereign, landmark. China has largely refused to recognize Taiwan as a sovereign nation. Why, on the other hand, US think this recognized. For North Korea and South Korea, they are also bringing war in that area. For Israel and Palestine, there's also conflicts. Saudi and Yemen, we have a number of them. This list here is not exhaustive, just to say that there is a lot of geopolitical tension, though Russia and Ukraine crisis on the limelight. So looking at the fact that Russia may actually win this battle, yes, because on the war front, they are more, they spend more on defense, they have more personnel, military personnel. For instance, Russian military personnel is over 1 million, and Ukraine is just less than 1/4 of that. So apparently, they are going to win the battle if we are to go by those strengths. But while Ukraine may not totally win, because they are getting some form of delays when it comes to support from Europe and a number of other NATO members. But when it comes to the war, because war is beyond politics, in terms of how it affects the economy, in terms of how it even affects Russians in the diaspora, and even and the way people will seal them globally, that Russia will lose the war, certainly. So moving on to the economics of the war, having considered the geopolitical part, you may wonder what gave Russia the impetus to actually go ahead with this war. When you look at top 10 exports by Russia, these items are very strategic to the war, and they are ranked among the top producers. For instance, fertilizer. We talk about food security, which is the core objective of the World Bank. Russia is the largest producer of fertilizer in the world. Talk of cereal, talk of mineral food. They are very, very well positioned. So, which is why the country is very important to the world. They know that once they're able to push using the economic power, and they may achieve a lot when it comes to what they want to achieve with Ukraine, despite the fact that the country only contributes less than 2.5% to global growth, and it even accounts for about just 2% of international trade. Even for Ukraine as well, even though we know that the country is well positioned in terms of cereal production, as a matter of fact, it depends on Ukraine for over 80% of wheat importation, which means these countries are quite essential, despite the fact that they don't contribute significantly to global growth. So really, what we have here is most likely that Ukraine is going to lose in terms of the economic implication. And going by outlook, we all know that this battle is a non-zero sum game. That is, the two countries are going to lose, in terms of the economic implication. They are going to lose the war. For instance, the FS predicted that Russia economy would decline by 11.2%. These are apparently optimistic. They are just looking at what happened in February, while Ukrainian economy is expected to decline by 45%, and it will be on the back of several factors. The fiscal condition of the country will be severely strained. We've seen significant sanctions on Russia, and we have also seen displacement, businesses, people, all of that in Ukraine. So even in fact, in terms of business confidence and even external sector, all of this will actually aggregate to impact the economy negatively. In a bit to provide further insight, we look at how top 10 economies actually depend on Russia. That is, we look at in terms of these two items, fertilizer and mineral resources import, how much of these items they get from Russia. So for instance, Italy, of the total mineral fuel imported by Italy, 21.7% came from Russia. And when you go to fertilizer, you see that China depends on Russia for 30% of its fertilizer importation. You can now know why China is a bit laid back. In addition to the fact that they also want to decentralize power beyond just the US, because Russia is very important to these top economies. So if you look at top 10 items that is traded globally, you see that mineral fuel is just third, but everybody knows that none of these items can be produced without mineral fuel, which is that Russia mineral fuel, which is a core of the country's economy, is so important to the world. And with this, you can clearly predict global growth, as my colleague as earlier said, because now that the world is subjected to high volatility in energy, you can predict that global growth will slow down significantly. So moving on to how all this would impact the world. We know that the impact is far-reaching. Point here is that it's going to actually disintegrate economic integration. We know that it's going to affect inflation, and we've begun to see the impact already. We know that this will also result to high level of food insecurity. I mentioned earlier that Egypt import 80% of its wheat from Ukraine. In fact, at some point this year, Egypt had to go to IMF to get funded to import wheat because of increase in its price. You know that to lead to high risk of unrest because of high unemployment and high cost of living, to go as far as resulting to what we call globalization, that is slowdown in globalization, or even at some point globalization, that is an autarky economy where people don't want to even trade with other economies because they want to global. But what is even more critical to us is how this will heighten market volatility, because this is where opportunity comes from. You know that heightened market volatility creates opportunity for very intelligent investor, and this could also create significant threat for investors that does not understand the whims and caprices of the market. Right, so that will take us to the resurgence of great inflation. I know we've discussed about this. We've had a lot about great inflation. So what is currently happening is not new in terms of rising inflation across advanced economy. For instance, this could also be traced back to 1975 to 1980, when the US inflation rose to 11.8% and 30.9%. This was largely traceable to so many factors, but at the center of the factor that led to this high inflation was increase in money supply, because the president of the US in 1975 to 1980, President Nixon actually increased money. He printed a lot of money. He ran, expansionary fiscal policy, because they felt that, increase in spending will bring the economy out of recession after the Vietnam War. And they also hinged it on the drive for great society. But unfortunately for this economy, which is what we are seeing now, was that GDP growth declined significantly in that period, particularly in 1975. GDP was 0%, and 1980, the same thing, we have about 0%. This also, predictably led to increase in unemployment. We are seeing the same thing happening even in 2022. Already, we're seeing that inflation is rising to record levels as a result of what? As a result of increase in money supply. So all of this, because even proud to 2020 size, prior to 2020, increase in money supply is just about 5%. But after 2020, that's 2021 and 2022, money supply has continued to increase by over 10% per annum. So this has even brought to fore again the importance of what Milton Friedman, a leader in economics, said, that inflation is caused by money supply, even though we are looking at other factors, energy and all of that. But he said inflation is caused by, increase in money supply, and which is why JPOA is hell-bent on raising interest rate, despite the fact that a number of analysts are scared of the risk of stagflation. He wants to just fall into the shoe of Paul Volcker. Paul Volcker, when he was able to bring the inflation in the US in 1980s, it was called the inflation buster. So we actually think that the new inflation buster in the street is now the JPOA, because it's going to go through or follow through with hike in interest rate and reduction in money supply, so as to bring down core inflation. All right. So that brings me to the inflation outlook. We've seen significant uptick in inflation. As a matter of fact, in Q1, US inflation averaged 6%, but the Fed, that is the US Central Bank, is actually looking at about 4.3% in 2022, which means at some point this year, inflation will decelerate, right? Due to a lot of aggressive move by the FOMC, that is the Monetary Policy Authority of the US, right? They are thinking that even at the current level of 0.5%, policy rate will be increased to over 3%. So all of this is expected to bring the inflation to 4.3% in 2022 and 2.7% and 2.3% in 2023 and 2024 respectively. In the same vein, the ECB, that is the European Central Bank, is also going in the direction of tightening policy because of the current shock to energy price that has led to increase. They're also seeing that inflation, even though it will increase to 5.1% this year from an average of 2.6 last year, it will decelerate in 2022 and 2023 and 2024. So that brings me to the end of this session. So I'd like to leave the floor for Robert to take us through how market reacted to this geopolitical tension and great inflation. Thank you.
Thank you, Temitope. I'm sure listeners will be wondering why we delve so much into the history or the politics of things in terms of geopolitical tension. And that's because it has a lot of impact on the market volatility that we have experienced so far in 2022. And if we look at the chart we're showing currently, you will see, the trend in market movement from equities to fixed income to global commodities, even cryptocurrency and real estate. And you could see that in this period of geopolitical tension and rising inflationary pressure, what it has characterized, particularly for equities and fixed income, has been, lower market valuation. If you like, if you look at what we see in terms of equities, we've seen, recent drawdowns similar to what we experienced during the pandemic, because there are two issues in question. How Russia and Ukraine crisis currently affects global economy, particularly is in terms of energy and all of the sanctions that could slow down economic activities. And for yields, this also has impact because rising energy costs would imply higher inflation. And of course, there are already talks, even before the Russian-Ukraine war, that there will be policy normalization of higher interest rates. So all of these are impacted on the fixed income markets, both in the developed and emerging markets. And we've also seen a toll of these across different markets, where talks around policy normalization have taken the center stage. Now, in terms of volatility, if you look at the sort of volatility that we have experienced, because if you look at the last part of our topic, we're looking at market volatility, which is the attendant impact of geopolitics or geopolitical tensions as well as great inflation as we pictured. You will see that we are seeing volatility closer to what we saw at the peak of the pandemic. And this presents a lot of opportunities, particularly because we are seeing significant drawdown in prices, which then present opportunity for investors to, come in at a much more, better valuation. Now, in terms of outlook, if you look at market volatility outlook, we're showing here, we're looking at it in terms of equities, fixed income, across asset classes, basically. Now, we think that this volatility experience may still dominate for the second quarter of the year, even going into the third quarter, because we expect higher interest rates to also come in on the back of higher inflationary pressure. Now, this will in turn have impact on the fixed income yields, both for developed market and of course emerging markets. And across other asset classes, we also see minimal or mild volatility, that we also somewhat provide some sort of cushion for investors in terms of the volatility that may dominate for equities and fixed income. Now, in terms of our strategy on how we think investors can, navigate all of these issues, there are three major issues we have put forward. We've talked about geopolitics, we've talked about great inflation, and we've talked about market volatility. Now, this market volatility is where the money is. So basically, when we are looking at the strategy, we're talking through what investors really need to do to take advantage of events happening globally. And if you cast your mind back when we were presenting our outlook for 2022, we had preached 5 major themes in terms of strategy for 2022. We've talked about cautious optimism, market timing, staying liquid, portfolio rotation, and of course, diversification. Now, we think that these themes are much more even relevant now because, geopolitical tension, which was not really envisaged to dominate in 2022, came in February, especially when Russia invaded Ukraine. And we've also seen pockets of other tensions, as we highlighted, the China, Taiwan, North Korea, South Korea, Saudi Arabia, Yemen, and a lot of other, geopolitical issues that may dominate in 2022. So, but we think that if investors, particularly we'll be able to time the markets and diversify across asset classes. This will, provide a lot of opportunities for them to profit. Now, across board, we think that allocation of your portfolio should still be skewed across asset classes, and we've identified 5 majorly: alternatives, bonds, equities, commodities, and of course, money market. And this ties to the overall strategy, which we think for 2022. And we believe that if investors, will stay, cautious and play alongside this strategy, which we preach, their portfolio would not be subject to too much risk in a very risky environment that we find ourselves in 2022. So for fixed income particularly, we believe that investors can consider both on the sovereign and the corporate side. There's a bit of mix that is expected between sovereign and corporate Eurobonds. And for them to be able to achieve some sort of stability, we think that playing more on the corporate side, which is a little bit more stable, especially in the international front, may be much more a better strategy than playing sovereigns that are a bit more volatile. But overall, I think we still seek stability ahead of the volatility in 2022. For developed fixed income particularly, we believe that the way investors can play this strategy is to still remain, positive about shorting their portfolios. So by short, we mean because we expect yields to rise. Now, the value of your assets are likely to decline. So what shorting does for you is to enable you to take advantage of when yields are rise, or before yields rise, you exit the position only to buy back when yields have risen, so that you're able to minimize the losses. Now, the way investors can play this, as we continue to preach, is direct investment in US Treasuries, which we are able to provide you support to do with a minimum of $200,000. For the local bonds market, at the beginning of the year, we crafted a portfolio, and as we speak, that portfolio returned above 5% for the first 3 months of the year. This is a strategy we believe that can still deliver in terms of the performance for the rest of the year. I believe if you would like to, take advantage of the local bonds market, one way to do it is to invest in our, Nigerian International Debt Fund, which is a bond portfolio, and comes with a little bit of stability and offers you a return slightly higher than what the money market gives you. Of course, there can also be direct investment, 200 million and above can assist you to do that. For the sub-Saharan African Eurobonds, in terms of equities, of course, we expect volatility to continue in this Q2 as well. But if you look at the portfolio we crafted at the beginning of the year, you'll see that your performance will have been about 3.4% down. Albeit, if you have taking the strategy of shorting at a time before yields rise, over the same quarter, you'll have been able to moderate the loss, if not completely eliminate it. So one way we think you can be stable, buying into SSA Eurobonds, is to do direct investment into specific corporates and sovereign. And with a minimum of $200,000, we are able to help you do that. Afro Invest Income portfolio in USD also helps you to achieve that objective, $25,000 minimum. It pays you a stable return, and then you don't have to bother about market volatility. Of course, Afro Invest Dollar Fund with a minimum of $1,000, you can invest in that. That also helps you to be invested in the sub-Saharan African market. For Nigerian money market, one way to invest is to buy into our Bluetooth fund or Afro Invest Income portfolio in Naira, with a minimum of 500,000. Now, if you look at what we preached at the beginning of the year, we said you should long CPs, and you agree with me that the last quarter, quarter one, has been flurry of issuances in terms of commercial papers, and these are just some of the listed commercial papers and the yield they offer. We think that is most likely going to continue but we may not see much aggression this second quarter, given that yield environment may also turn on the risk-free investment. For equities market, we are still staying close to our strategy, which is to leg into cheap stocks as market presents, both globally and within the Nigerian market. We are going to invest in cyclical sectors, even though we think that this current geopolitical tension will slow down global growth. We still believe that the economy is expected to grow. So investors should invest in cyclical stocks. And then we are still going to be focusing on growth and value stocks. And if you look at the portfolio we crafted, so for the developed market, we were mildly bullish. And if you invested in our portfolio at the beginning of the year, by now, you would have returned about 5.23%. I mean, just for the 3 months of the year. And for the local market, the portfolio we crafted was down by 1.25% on the average, but we still remain positive about this portfolio to deliver before the end of the year. You can invest in the local equities market by buying into our Afro equity fund, which is properly managed, and then you don't have to bother about the management will do the job for you. On the alternatives, which is the last set of strategy we're looking at, we are still risk conscious on alternative. We believe the alternatives will still provide inflation hedge for you, and of course, not taking it too long. Within the space of alternative, even though they are generally illiquid, you can still stay within a shorter gestation, investment horizon, so that you're not, too, long into the core. So one way we do this for you is to give you different opportunities that you can invest in, both in real estate and in commodities. We have a product in-house, Afro-based alternative portfolio, that is invested across alternatives, particularly real estate and commodities. For the real estate, it offers a return of above 12%. And for the commodities, it offers you a return in excess of 12 to 14% as well. This product will bring out from time to time. Overall, if you look at the strategy that we have preached, we are a bit more conscious of the risk environment, both globally and locally. And we believe that one way investors can sustain, staying less risky in the market is, to apply one of those, all of those 5 key themes which we preached at the beginning of the strategy session. I mean, I'm specifically speaking to diversification, timing the market, staying liquid, cautious optimism, and of course, portfolio rotation in and out between long and short dated instruments, particularly on the fixed income. So at this point, I think we've come to the end of the presentation, and we open the floor for questions and answers. So I will hand it over to Raymond to anchor that session. Thank you.
Okay, thank you so much, Robert, for the insightful presentation so far. A quick recap of the 5 salient strategies for 2022 being diversification, cautious optimism, liquidity, market timing, and portfolio rotation. So we'll be going into the question and answer session. From the chat box, I could see that our esteemed are following, and we're glad about that. So this question is to Robert. So market timing has been proven to be a difficult strategy. How do I implement this strategy in for my Naira portfolio, given this geopolitical crisis?
That's interesting. Of course, yes, market timing is, over time has proven to be difficult because, nobody is sure when the market has bottomed. But one way that you can be sure of that strategy is if you take position when prices are cheap. And if you look at our, fixed income and equity strategy, we're particular about legging into cheap assets. Now, a case in point, this last quarter, we've seen up to this moment that we're speaking, we're still seeing prices that are relatively cheaper relative to their levels in 2021. So if you are a strategic investor, one way to look at it will be identify that level that you're comfortable buying. And I'll give you an instance. There are yields within the, Eurobond space, for example, that are within the double-digit territory, and a year ago, they were all in the single digits. So relatively, that is cheaper compared to the peak that we saw in 2020 or 2021. Now, but the issue then will be most investors will be thinking, if I buy now, yields can still go higher, and sometimes, because it's difficult to time the bottom, so when we say timing the market, sometimes you can study that over a short time, especially if you're an active trader. I can look at it that, okay, if market is at a level lower than it was trading last week, that's a good level to buy, right? I can go in and then, over time, and observe how the market will perform. Now, generally speaking, because we know that the global economy is normalizing after all of the, stimuli that dominated in 2020 into 2021. Now, investors expect that yields will continue to rise, at least on the fixed income side. Now, that understanding just makes it possible for prices to get to some levels that are, that are even beyond, what valuations can support. And that is what we see happening at the moment. The level that the market is trading right now in the sub-Saharan African market is slightly higher than the lowest we have seen so far in the year. At a time when, Russia invaded Ukraine, we saw it at the lowest level. But market has recovered between then and now. But it can still get back to that level because policy normalization is ongoing. So you may not be able to time the bottom, but positioning at a time when market is already low is good enough for you. And it's good enough for you to be sure that you will reap the benefits. Thank you.
Okay, thank you so much for that answer. I'm hoping that it clearly answers the issue. Okay, going on, I can see that the participants are keen on dollar fund. So I'll be calling up Babajide Atolagbe to give a little insight into this fund, give us the return yearly, the return in the previous years, and how well investors could optimize this fund. So thank you, please, Atolagbe. You have the floor.
All right, thank you. Very quickly on the dollar fund. So the dollar fund, our Afro dollar fund, is a mutual fund. Like you all know, that is largely invested in sub-Saharan, Nigerian Eurobonds, both Nigerian corporate. And the fund was launched in 2020, and in that year, the fund returned 14%, which was the second best performing, dollar-denominated mutual fund in Nigeria. Currently, as we speak, the price of the fund is around $106 per unit, and the return we have on that fund is as high as 6.3%, and that is relatively high compared to what you have on the 5-year Eurobond yield, right? For Nigeria, 5-year Eurobond yield, which is yielding close to 6.25%. One of the reasons why our yields are, slightly competitive compared to what you have on the 5-year Eurobond yield is because we've strategically invested in portfolio in securities that have long yield, right? That have high yield, right? Both sovereign and corporate. So that's that is one of the objective of the fund, and of course this is part of what investors would also benefit from because the fund is heavily invested in high yielding investments.
Thank you so much for that answer. Okay, we're taking one more question, and it's relating to equities. So a question goes: the main purpose of business is profit taking, right? And the participant is asking how we strategize in stocks, usually the selection and how we identify what stocks to buy and what stocks to sell, and at what point we do that. So for this, I'll be calling on Temitope Amosi to take on this question. And also give an insight to the Afro Invest Equity Fund. Thank you.
Okay, thank you, Raymond. So on the question of what stock to buy or to sell, when to sell and when to buy, and how to even choose the stock. So at different factors, which could be in form of, it could be hinged on your objective. One, if you want to actually get dividend, or you are in the market for, price appreciation. And again, you could also look at, so there's no rule to choosing stock, to the choice of stock is not cast in stone. For instance, we've noticed that since last year, oil sector stocks have been gaining significantly, and it's on the back of the current rally in the oil market. So maybe about in 2020, that did not happen. So it could be as a result of, changes in the economy, could be as a result of, structural change in the economy, but you also know that some sectors are fundamentally sound. You look at some banks, right? While you look at other ones that are important to the economy, I could say that these sectors, have what I would call inelastic demand. For instance, telecommunication, MTN. So MTN remains very relevant. So if you look at those factors beyond just the technicality of maybe you want to look at value stocks or the growth stock, but you could just look at the dynamics of the economy. Which sector is very important to the economy or to the economy, and which stocks are within the scope of that, of that sector. And when to sell, to buy is a function of, different factors. You may want to buy a stock after the declaration of the results because you know that, yes, at that point, investors will sell off, and you could choose to buy maybe a month or so to the release of a particular company's result because you know that this company is going to deliver, very good return. A very good example of that is Seplat. We know that there has been significant uptick in oil prices. That has already told you that, for Q1 result, you should expect an impressive performance. So you could also look at, that to tell you when to buy, that you are to buy now and you are to sell off, when reposition again because market will start, investor will start selling. And again, you could also use what we call 2 weeks high. That is now the technical aspect. You could look at 52 weeks high and look, haven't done your fundamental analysis. You could say that, okay, this stock is closer to a 52 weeks low, that is the lowest price in 1 year. So that could give you an idea. Having known that the stock is strong, you could actually position. And if you know that the stock is inching up to the 52 weeks high, you could also exit. So, but when it now comes to the AIP, the AEF now, the Afro Invest Equities Fund, concerning the fund is solely focused on fundamentally strong stocks on the Nigeria Stock Exchange. So, and it's professionally managed. So, for the fund, we've ensured that it's carefully managed such that we look at market timing. When we observe that market is highly volatile or to the downside, we reduce our exposure in terms of the beta. And when we know that market is going uptrend, we also choose sectors that are highly volatile, that is, will respond faster to the uptick in the market. So that's all I will have to say on it. Thank you so much.
Thank you, Dr. for that insightful answer. And this brings us to the end of the session. Please note that the presentation would be sent to all the mails and also uploaded on our YouTube page for your consumption. With this, we are thanking you extensively for being a part of this quarterly webinar and look forward to seeing you at the next webinar. Thank you once again and enjoy the rest of your quarter. Thank you.